Good morning. It's Jeffrey Christian of CPM Group. It's 10:50 on Friday, the 11th of November. Happy Veterans Day for everyone, or Armistice Day, 11/11 at 11:11 a.m. I hope to be done by then. I wanted to talk today about precious metals prices in the context of recent inflation data that came out yesterday and the FOMC increase in interest rates. So I want to talk about inflation, interest rates, and everything else that is affecting precious metals. What we've seen over the last couple of days only, really Friday and of last week and through this week, so precious metals and other financial assets have actually started to rise sharply. They're still very volatile, and we're not out of the woods. The potential for further weakness remains in those markets, but we have been saying for a year that we thought that the prices would be weak in the second and third quarters into September, but that we would probably see higher prices in the fourth quarter moving forward into 2023 for gold and silver. And October saw weak prices, but we also saw higher interest rates and stronger interest rates and a more forceful move against inflation by the Fed than we had been anticipating in the first half of this year, and that the financial markets had been anticipating. So we are not out of the woods, but it is starting to look as if the prices are recovering. There are signs of peaking inflation. There are signs that we are potentially moving toward peaking interest rates. We'll talk about these two things in a little bit. And you've seen the political, economic, and financial markets continue. There are concerns about financial bank instability. The reality is that it's not as problematic as it was in 2008, despite what the gold promoters might have you believe. We've seen mixed U.S. election results, which means probably that we'll have a stalemate in the government continuing. So it's more of the same probably. We've avoided the worst of the two extremes in the political spectrum, but they're still there. China's hard line has become even harder. That's starting to emerge in the post-Chinese Communist Party Congress period. And Russia's marching toward losing the war in Ukraine and also suffering mightily internally, including signs of internal dissent and terror bombings and things like that. We're seeing a reduced immediate recession fears, but many of those issues remain unresolved, and they're likely to be problematic later. So people who were convinced that we'd be in a recession in 2022, 2023, a significant recession, now we're saying, okay, it is most likely that it would be 2024, 2025. We've seen various banks mark down their probabilities of a recession starting in 2023, and they're looking to 2024. That doesn't mean that it can't start in 2023. It just means that, as we've been expecting, we probably will see weaker economic conditions in most parts of the world in 2023, and they'll come home to roost a little bit later. Those are those storms on the horizon. Talk about them in a second. Go into interest rates and inflation. First, the prices. Gold and silver prices have risen sharply over the last few trading days. They have moved out of that consolidation period that they've been in for several weeks or months. And they're starting to show signs of increases. We have been expecting this. We continue to expect it, but it will be a bumpy ride. The markets remain vulnerable to downward moves because the world remains in the woods. There's a lot of uncertainty there. This chart, which we use every month in our precious metals advisory, the bubbles, the size of the balloons represents how important these issues are for the world and for gold. The movement up and down is the probability that they will be problematic for the world, and if they're green, beneficial for gold investment demand and prices. in the next 6 months. And the movement left to right is the likely impact on investment demand for gold and silver and prices. You can see they're all clustered now in the upper right-hand corner, and they have been for some time. And this is all kinds of things that could go wrong. Higher than expected inflation, which we've seen, increased political risks, both domestically in the United States, domestically in other countries and around the world, deteriorating U.S. economic conditions. One of the negatives for gold, it would be a sharp increase in equity markets. It's still possible, despite what people think, and also bond market declines as a negative. You're looking at ongoing infections, not just COVID, but RSV and other things now, higher equity market volatility, deterioration of Chinese economic data, deterioration of economic conditions in Japan and Europe. There's a lot of problems, and they are issues, and they have moved over to the right. They're more likely to have major impacts on precious metals investment demand and prices. And they've also moved upward. So they're clustered in there. And then we also have in our precious metals advisory longer term factors, global tensions between the United States and China and the rest of the world, the ongoing creation of an asset bubble, increased protectionism, decreased trade, socioeconomic crises, debt, not just federal debt, not just sovereign debt, but private debt as well. Breakup of the euro area, something to watch out for in the longer term. It's not going to happen in the immediate future, and other factors. These are recent Fed funds rates, and we saw an increase in the Fed funds rate again in early November. They've gotten up to a target range of 3.75 to 4.0%. And you can see that's relatively high in the context of what we've been since 2018. And we had spent a couple of years bumping along close to zero. This puts that in a historical context. And as I've said repeatedly, yes, interest rates have risen, but they are very low. And you can see even at 3.75, 3.8 on an effective midpoint range, you can see that that's pretty much lower than it has been for most of the period of time from the late 1960s into 2000. So interest rates have risen. It obviously has real effects on precious metals investor attitudes and prices, but as well as the broader economy. But you have to put it into the context of where we are. We're nowhere near where we were in the 70s and early 80s and into the 90s. Only gold promoters believe that there's going to be an imminent pivot. And you keep hearing people talk about how the Fed's going to fail. Inflation's going to go even higher, and that there has to be an immediate pivoting of Fed policy away from fighting inflation toward saving the economy from an imminent collapse. You hear that from the gold promoters, but you don't see it in the broader financial market. This data is from the CME's FedWatch tool, where basically financial market participants bet on or indicate where they think the Fed funds rates are going to be. Now, the current Fed funds rate, as I said, is 3.75 to 4.0. So we always look at the low end, 3.75% interest rate right now. The most probable figures, and these are as of this morning, they changed actually since the inflation figures came out yesterday, slightly. The most probable expectation of the broader financial market is another 50 basis point increase when the Fed meets in the middle of December. And then two more 25% basis point increases when the Fed meets in February and in March. So the market consensus presently, and it changes day to day, changes within the days, is that we're going to go from 3.75 effective funds rate base to 425 to 450 to 475 over the next 4 months, 5 months. Then it peaks and it plateaus, and it stays there until November. Now, it starts to decline in November, and I'm sorry, I forgot to put in the December figure. It's another 25 basis point decline. Hurried to get this done in time for this presentation. So we look at the broader financial markets expectations of the Fed funds rate, and we see them continuing to rise and really rising another percentage point over the next 5 months, and then plateauing for most of 2023. Economic factors weaker, stalemated government, other political issues, further developments that lead toward the resolution of the Russian invasion of Ukraine, further developments in the Eurozone's political structure, inflation coming down. The expectation, the consensus expectation that the New York Fed surveys people around the country is that a year from now, inflation probably is going to be around 5.5%. So you're looking at a further reduction in inflation. You're looking at a further reduction in economic activity as we slouch toward a recession. And in that kind of environment, the markets, the broader markets, the financial markets, expect interest rates to rise for the next few months and then plateau for most of the period from March into November. And then you start seeing 25 basis point declines in November and again in December. Again, I apologize for failing to get that data in at the bottom of this table. I was distracted by the markets and hurrying to get this done. Current inflation, again, put it in a historical context. Yes, it has spiked very high. It has spiked high now for a year and a half. There's a combination of factors there. People keep talking about monetary policy as if monetarist theory actually reflects reality. The reality is that you have a variety of fundamental economic supply and demand imbalances across global economies and within the United States that have been the primary factors: short-term, cyclical, long-term, secular increases in prices and in wages. Those are the primary factor. The secondary factor is the Fed fund, fiscal policies of the United States and the massive borrowing of money, not just by the US government, but by state governments, by other governments, and by private industry and consumers. There has been an increase in spending and debt-financed spending. Monetary policy comes along and supports that. The real factors behind inflation have been those economic supply and demand imbalances and fiscal policy. And fiscal policy probably isn't going to get better, at least in the near term. If you look at the inflation figures that came out yesterday for October, you can see about 0.4% increase in the 1 month percent changes. And we like to look at that because that tells us what's going on in the month. And you can see, yes, we had very high inflation. This only goes back to October 2021. I was trying to get it back further. But starting in March and April of 2021, we started to see an increase in inflation. It did come down in July and August. It was looking very scary economically. But then it's been about 0.4, off from the 2021 increases, but still high. Still needs to come down further, and it probably will come down further. If you look at it on a year-over-year basis, on the 12-month rate of change, you can see we've seen headline inflation coming down now for 4 months. And that headline inflation has been coming down primarily because of lower increases in energy prices. And food prices are still rising, and they're rising sharply. If you take out the more volatile food and energy and you look at what they call core inflation, You can see that actually it was rising in August and September, but it has come off a little bit in October, about 6.3%. And it has been pretty much flat now since the first quarter of this year. So you are starting to see some peaking in inflation, some of those short-term cyclical factors and the short-term factors that were related to the lockdown and the economic recovery seem to be behind the market, but there are longer-term secular issues that are keeping inflation high and probably will keep inflation high by a recent historical standard for several years to come. All of that pretty good for gold and silver investment demand. If you look at the October inflation, the big black bar is increases in energy prices. That was where the major increases in prices were last month. Food was the second largest. All items over there. And that green bar is everything ex food and energy. Still high, 6.3%. That's what I got now for today. I'll be back next week and I will talk a little bit more about silver investment demand, I hope, physical silver investment demand. In the meantime, you can go to our website, cpmgroup.com, and find other free reads and find information about some of our services, including the gold, silver, and platinum yearbooks, which will give you a very solid grounding in not only the current year and last year's markets for these precious metals, but also a lot of historical background. Take care. Have a good weekend. Celebrate Veterans Day, Armistice Day. Take care and watch out for the whole world. We'll see you next week.